I cannot fully express my gratitude to Ned, not only for inviting me here at the 20th anniversary of the center, but for being able to participate in the celebration of your round birthday. This is really what is, I think we met in 1985 when you came to the Bank of Italy. You came in 1985 visiting to the Bank of Italy, and I was the one who had decided to invite you. And I remember having lunch with you in a small restaurant near the Bank of Italy. And every time going in, I was saying, when you win the Nobel Prize, we're going to write it on the shop. The shop is no longer there, but you did win the Nobel Prize. So I really want to voice my great affection for you together with Daniela, and the pleasure of having the privilege to be here. I'm going to tell this a short story. Short also because I thought I had less time than I've been assigned to speak, but that's all right. It's worse when you speak too much than when you speak too little. It's a story of the Italian economy that is very much in the spirit of Ned's work. Ned has taught us that growth and prosperity depend on entrepreneurial spirit, I'm quoting, and a chronic and endemic indigenous innovation. It depends on creating room in societies for individuals to think for themselves, find adventure, let free their imagination and journey into the unknown. Accordingly, he sees slowing growth and productivity as a failure of society. To breed innovation and individual creativity, a failure that may sometimes lead to a crisis in democracy. And the story I'm telling you about the Italian economy fits over the past 30 years, but I'll show you the long picture, fits very much within this approach. So, how can I, okay, I have it. First of all, you can see here what extraordinary feat Italy did between unification and, well, the year 2000, if you want, or what have you. Italy in 1861 was an extremely poor country. The riches of the Renaissance had long gone. And with, look, life expectancy, 30 years, first-year death rate, children death rate, 289, income distribution, Gini coefficient 0.5, people in absolute poverty, 40% of the population, and literacy rate, 22%. And in the early 2000s, we were like France and Germany, basically, okay? Per capita income, GDP per capita, 25,000 euros or dollars is about the same. Life expectancy, first-year death rate, income distribution, people in absolute poverty, and literacy rate, as you see. So an extraordinary feat. Until basically the middle of the 90s. And then the machine somehow stopped. The mechanism for growth basically has broken down. And we are still a rich, prosperous country, but we're a prosperous country that over the past 25 years has gone nowhere. Zero growth. And look, up until you see here the kind of convergence that we've been able to achieve. You can see that in 1995, basically, we were almost like Germany, France, and like the United Kingdom, who had been performing less well. We managed to become a rich and prosperous country. Then we stopped. And if you look at the data that you have here of Italy's GDP per capita as percentage of GDP per capita in 4 other developed countries, we basically have already fallen back to where we were after the war, in relative terms. So I think you understand that this is quite a dramatic change. It's not simply a difficulty, okay? We are back to where we were in the 1950s. And I think there is an insufficient understanding of what is happening and whether or not this crisis is permanent, whether there are things that we can do, whether it's an accident, or whether something fundamental has happened. Okay? Now I will call your attention. Of course, Italy has suffered all the diseases of the other advanced countries. Okay, there is discontent, there is immigration, there is a sense of loss of identity, there is fear. So in this we are like the others. But I'm trying to argue that we have a special disease. There are 2 things that I would like to call to your attention. The first one is that in the past 30 years, the large industry has basically closed or moved away from Italy. It has disappeared. It's no longer there. And the average company size continues to diminish. Look at this little table 3. Well, if I can manage to keep it there. What you see there is that the share of employees working in companies with more than 1,000 employees for the total economy has fallen from 19 to 14%. In construction, it has fallen from 7% to 1.5%. In manufacturing, from 22% to 15%. In construction, there is also a collapse of an intermediate layer of companies that you see, those between 50 and 100 and medium-sized construction companies, whose share in employment basically fell by 2/3. Okay, so the first really dramatic thing is the disappearance of the large industry. And this decrease in size doesn't seem to stop. You don't have it in the data that I'm showing you here. What's wrong here? Next. Okay. I don't have the data here. These are the census data. But if you look at the ensuing census, the decrease in size, in company size, is continuing. And this is a unique phenomenon about advanced countries. It doesn't happen elsewhere. The second thing to which I want to call your attention is, of course, the explosion of public debt. Why do you get all this debt? In an environment in which growth is slowing down continuously. You see the dotted lines in the decades from 1980 to 2010 going down to 0 to all practical purposes. Now, what has happened? What has happened is that basically Italy went through where is it? A period of very harsh social unrest in the 1970s. Now, this is not without explanation. Growth had been achieved with cheap labor and enormous displacement of labor from the south to the north in very harsh working conditions and often living conditions. Okay? But at the end of the 70s, at the end of the 60s, you get a sort of general revolt in industrial relations. Violent industrial relations that continue for a decade and that basically made the functioning of large enterprises that compromised the function of large enterprises, and which must be seen as the main reason why the large enterprises either closed down or walked away. The political system, so the companies reacted by downsizing or going out. The political system reacted by trying to finance rather than adjust disequilibria. The simple idea was we subsidize everything that we can to maintain labor and contract conditions out of the market, incompatible with the market. It was a very simple solution. We subsidize everything that we can subsidize to continue out of market conditions. So these are the two main developments that shaped, in my view, the evolution of the Italian economy. Now, cultural legacies of these developments. First, widespread hostility to capitalism and the market economy. With, in addition, a specific connotation, which is very strong resistance to mechanisms of selection of human resources, of companies in the market, of supply contracts in a very large public sector, based on merit, quality, and competence. The effect of what we saw is the idea that much of the society became hostile to market mechanism. And this has affected deeply our societal culture. It is widespread sentiment in our society. On the other hand, the reaction of family capitalism, as you know, we have a strong system of family companies, was to close up, avoid to open their capital to outside investors, keep a tight grip on the management of business, and thus failing to bring into their companies the managerial competencies required to manage new IT technologies. This evolution was anticipated over 2 decades ago by then Columbia professor Mark Rowe. He's now moved to Harvard. He's a lawyer, a legal expert, who saw that such a closed corporate governance system, he saw it as the result of widely divergent values between company owners, the capitalists, and the rest of society. Because the distance between values is so broad, you basically manage the companies with your family members and don't open your capital to outsiders because there is no trust. It is as simple as that. So we come to the explanation. Several decades of low investment and weak technology seems thus to be related to a systemic lack of confidence and closure to surrounding society by the family companies and the widespread anti-market social culture. These are features specific to Italy that in a way distinguishes our economy from the other advanced European countries. Now, why stop then? Well, it is very simple. To do certain things, small is beautiful. And for a long time, you know, we sort of celebrated our small companies as the solution, as our specific solution to growth. But when IT technology arrives, it doesn't work anymore. You crash against the fact that you cannot manage IT with a small size and these rudimental management structures centered on family members. And so, lack of trust was in addition aggravated by recurring episodes of acute political and financial instability generated by higher and higher public debt. Because every now and then, financial markets question whether we can sustain this debt. Normally, we need then harsh adjustment measures, cut here and there, change the conditions for investment and profitability. And of course, people remember, investors remember, and companies remember. So Italy found itself unable to cope when the IT revolution arrived in the middle of the 90s. And the structural weaknesses that I have described, that structure of company management and capital, the inefficiency of the public sector, and the general attitude hostile to market process and new technology combined to bring our economy to a complete halt. So, but this is not the end of the story. As Ned had forecast and let's say imagined, this thing is not without cost for the support to democracy. It's gone. No, it's still there. We still support democracy a little bit. You see what happens. Apparently Spain is suffering a little bit like us, but Italy has become the country with the highest dissatisfaction with democracy and confidence in change within the European Union. And the political system in the end produced as the result a right-wing government which was unthinkable with this composition and this kind of people 10 years ago. And here you see the danger. Without growth, support for democracy diminishes, and in the end, you find yourself governed by unlikely people, let's say. I think this is the story I wanted to tell. Well, I was not too short. I can stop here.